What's up guys, and welcome to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. In this video, we're going to be looking at some of the greatest gains and losses on the Wallstreetbets forum of the past week, so we can learn from other traders' experiences. This video is made possible by our channel members. Members get access to all of our non-time sensitive videos one day in advance, and are able to vote on which topics we make videos on. First off, we have user Speedy Corndog, who found himself in the unfortunate position of having lost 80% of his life savings over the past month. On his 18th birthday, he opened up a Robinhood account and deposited $14,000, which amounted to his entire net worth at the time. Armed with the knowledge that stocks only go up, he bought call option contracts on Apple, the QQQ, Tesla, and Snapchat. While most of these stocks have done very well over the past year, with the tech-heavy QQQ almost doubling from the March lows, this Wallstreetbets user had the unfortunate timing of buying in almost exactly at the top. Most tech stocks have traded sideways or even declined over the past month, causing his calls to expire worthless. He didn't just go long, he also bought some puts to hedge his portfolio's net exposure to the market. He bought puts on DoorDash, betting that the stock price will go down. And while DoorDash did in fact decrease by more than 20% over the past month, he bought in too late and his strike price was too low, leading to a $1,000 loss on his position. Despite being new to trading, like a true degenerate, he went straight into options trading without ever touching a share. He never did DD and just picked stocks he saw on the Wallstreetbets forum, or chose them based on his gut feeling. His lack of coherent strategy ended up in him constantly buying high and selling low, ultimately leading to a 79% or $11,000 loss. Many Wallstreetbets users in the comments section appear to think that the OP is cursed and any stock he buys is guaranteed to crash. They ask him what his current plays are to make sure they avoid owning the same stocks as him. He says he's currently looking at Ford and Apple as possible longs. He just sold Snapchat earlier that morning. Now that he doesn't own it, it's liable to moon pretty soon. User CP5 says that he is putting 2,000 pounds into Snapchat because the OP sold. We wish you luck on your future plays. Before we get into the good stuff, Public is going to be giving you a free stock worth up to $50 when you click the link in the description below. Alright, let's continue with the video. Next off, we have user RMR5, who is down about $10,000 on his Rainbow Bear positions, which he has been holding for almost 4 years. In 2017, he looked at the Shiller price-to-earnings ratio of the S&P 500. With the ratio nearing record highs, he concluded that the market was overvalued. Robert Shiller is a Nobel Prize-winning economist whose research mainly focuses around financial economics and specifically asset price bubbles. He developed the cyclically adjusted price-to-earnings ratio, which is calculated as the price of a stock divided by its average earnings over the past 10 years. The rationale is that the company's earnings are very volatile and will rise sharply during an economic boom. So using the average earnings over the past 10 years gives a better representation of what the company can earn during normal times. When the Shiller CAPE ratio is very high, this signals that the market is overvalued and primed for a pullback. The OP saw that the ratio was very high in 2017, so he loaded up on the SPXS, or the Direxion Daily S&P 500 Bear 3X ETF, which returns negative 300% of the return of the SPY on a daily basis. Unfortunately, despite the market's high valuation, it continued to grind higher over the next few years, and because the SPXS is 3 times leveraged, he ended up losing 95% of the position. While the market may in fact be overvalued, it is important to remember that shorting the market carries extreme risks and almost always ends in disaster. As the noted economist John Maynard Keynes says, the market can stay irrational longer than you can stay solvent. Next off, we have user Specialist Dust 9320, who's down more than $150,000 on his EV stock positions. He owns 7,451 shares of XPeng, 2,001 shares of NIO, and 2,001 shares of CCIV, the SPAC merging with Lucid Motors. On a percentage basis, CCIV is his biggest loss, down 42%, but on a dollar basis, XPeng is his biggest loss at negative $107,000. XPeng is a Chinese EV manufacturer that has benefited from the EV craze of 2020, increasing more than 230% to a high of $64 at its peak in November. Unfortunately, the OP bought near the top and the stock has pulled back more than 40% from the highs. This pullback represented a 6-figure loss for the OP. NIO is a similar story, increasing more than 25-fold before pulling back 30% from the highs. And CCIV was the most dramatic of them all, skyrocketing almost 500% and tanking more than 50% in the span of just a few months. Despite his recent setbacks in the EV sector, he has no plans on locking in his losses anytime soon. He is maintaining his position in XPeng and took advantage of CCIV's recent pullback to double down, adding another 3,000 shares. He also initiated a 3,000 share position in Palantir, which is worth about $70,000. Many WallStreetBets users still think the EV revolution is in its early innings, and 2021 may be just as good of a year for EV stocks as 2020. The OP agrees and says he plans to hold his Xpeng shares until they reach the moon. Next, we have a 100-bagger from user MyNameJeff. This WallStreetBets user made hundreds of thousands of dollars playing several names, including NEO, ENPH, SE, GDOC, and BABA. However, the majority of his gains came from pouring all of those gains into AMRS, or Amyris Inc. Amyris is a synthetic biotech and renewable chemicals company. They produce chemicals for things as widely varied as cosmetics and synthetic protein. Their claim to fame is their ability to make these chemicals renewable, making them a favorite of ESG investors. Over the past half year, their stock has done exceptionally well, skyrocketing from less than $2 a share to $21 a share today. In the span of just 3.5 months, the stock has become a 10-bagger. This WallStreetBets user was able to profit off of Amyris' insane run-up by owning nearly 10,000 shares, in addition to significant options positions. He bought 9,370 shares of Amyris for an average cost of about $11 a share, which has now more than tripled in value for a $120,000 gain. He also owns $130,000 worth of calls of various strike prices, most of which expire in January 2022, although he does have a $12,500 position in 30 strike calls expiring in mid-April of this year. On that position, his sole loser, he is down 2.5%. In contrast, his 17 strike January 2022 calls have increased in value by 237%, or $41,400. Overall, he is up more than $200,000 on his positions. He basically has earned himself a Ferrari by playing the markets. His chart over the past year has been an almost perfectly exponential line upwards, starting with plays on NEO, Enphase, SE, Teladoc, and Alibaba. This phase saw his account start at $3,481 and climb to about $80,000. At that point, he pumped all of those gains into AMRS, which brought his final portfolio value up to $315,000. Assuming that he didn't deposit or withdraw any money during this time, that means that he 100x'd his money. Congratulations on your great trades. However, even those gains pale in comparison to the sheer dollar amount of our next post, courtesy of user jskrilla998. He also got into AMRS stock early, at about $3.67 per share on average. Even better, he went all in for 19,000 shares. Since then, Amyris stock has 5x'd, bringing his $69,000 investment up by $360,000 to a grand total of $430,000 today. As far as what the reasoning for this play was, the OP says that he read a DD post on the WallStreetBets forum about why Amyris was a buy, as well as a Seeking Alpha post. Seeking Alpha contributors were bullish on the stock due to new products and molecules it was developing, as well as several major deals they were about to close. A recent DD post on WallStreetBets goes into great detail about what the company actually does, why it is differentiated, and why the industry it plays in is a secular grower. In essence, they are able to bioengineer microorganisms to produce chemicals and molecules that are difficult to produce synthetically. This allows them to produce expensive chemicals using only waste products from things like sugarcane stalks. In addition, they are the only company engaged in this type of operation that is profitable and self-funding, according to the DD post. Even after this massive 10xing, the OP thinks it is just the beginning. However, user Rigobueno warns that if he buys the stock, it will tank instantly. Congratulations on your gains. Alright guys, that wraps it up for this video. If you like this content, don't forget to like, subscribe, and share. As always, thank you so much for watching and we'll see you in the next video. Wall Street Millennial, signing out.